So one of Warren Buffett's most famous quotes is that compounding interest or compounding gains is the eighth wonder of the world. The way we structure our trades, a lot of people ask us, why do you structure the trades the way you do? There's a lot more profitable trades out there on the market that can get 1, 2, 300%. And we like to structure it using the Moneyball analogy. Now, a lot of you guys may have heard of this or may have seen the movie starring Brad Pitt called Moneyball, but it actually has a story about statistical analysis behind it. So in the late 90s, a guy named Billy Beane became the general manager for the Oakland A. It's a baseball team out of Oakland, obviously. He liked to utilize statistical analysis to pick his players. So most big sports teams right now have a couple of really big stars. So you've got LeBron James in basketball, you've got Trout in baseball. You have big players, big names that generally score a lot of your runs or make a lot of your points, and those are the key to winning. Sometimes these super teams that people put together. So Billy Beane was a little different. He used statistical analysis to try and pick players that could get you on base. So the idea was he didn't want home run hitters. He wanted kind of no-name guys that were consistently getting people on base so they could move from first base, second base, third base, and eventually get runs batted in. He wanted to get people home. Now, it wasn't very flashy, but he thought that using statistical analysis, he could draft enough players that would just get on base and drive people home, that they could run up the score and eventually get wins. So the idea is to get small little base hits, and they'll go for all the home runs, and add it up over time that those base hits would get them wins. So we like to trade using that same statistical analysis theory. Let me show you our compounding calculator that we built that's going to show you why compounding gains are so important and why small little wins that are seemingly insignificant can add up over time to be, massive gains. So as you can see on the screen here, this is our compounding calculator. These are the three areas that you're actually going to fill out, these three cells in green. You'll use this one alone, which is a total percent of capital in use. So the first one is your starting capital. We've typed in $10,000. Let's say you're pulling your money out of a retirement account, moving it over to a self-directed IRA, or you're putting your savings in your brokerage account. Whichever way you're doing it, you are starting your account balance with $10,000. And let's say your plan is to add an extra $300 per month to your account. So $150 per paycheck you set aside just as investment that you'll utilize in your trading account. And let's say your monthly ROI is 4%. Now that doesn't seem like a lot because a lot of these guys are out there expecting 100% returns each month on their trades because they're trying to go for those home run hits and trying to make big money on each trade. For us, we're going to use the Moneyball approach, and we're going to try and get a lot of tiny little wins, and hopefully we win 9 out of 10 times, and those little wins over time will amass great gains. So at $10,000, I'll show you how the math works here. So $10,000 up here is your starting capital. Now $10,000 times the 4% return, that's going to give you $10,400. $10,400 right here, plus the $300 that you add per month becomes $10,700. Now $10,700 times this 4% is going to give you the $11,128 and so on. So that's how the math works, just so you can see with full transparency that these compounding gains are actually adding up or completely factual. So it doesn't seem like a lot in the beginning, but they're going to start to snowball. So in year one, your $10,000, you'd actually double your money in this scenario. So you turn $10,000 into $20,218. That's of course getting your 4% and then adding $300 per month in additional monthly deposits. So you're adding quite a bit to it, but you're also getting the 4% each month, and that's adding up to $20,000. Now, $10,000 doesn't seem like a ton of money, right? It's throughout the year, that's $800 a month, something like that. So it's not a ton, it's not something to write home about, but over time it's gonna stack up. So if you left it in there and then you did the same thing the next year, you were able to add $300 per month and then get a 4% return per month. You turn that $20,000 into $37,000. Again, that's not a ton of money, but let's watch as it continues to compound. 37 turns into 64, 64 to 107, 107 to 176, then 286, 464, 747, 1.2 million, 1.9 million at the end of year 10. So you can tell that just starting with a $10,000 starting capital, adding a reasonable amount per month, and getting a reasonable ROI, if you let those compounding gains roll over time, you can turn a very small sum of money into a very large sum of money. And this is almost $2 million over a 10-year period. Now, of course, there's taxes and things that have to take effect here, so this number would technically be smaller, If you're trading on a margin account, you could actually use more capital than the $10,000, so this number could actually be bigger. So there's a lot of other factors in here, but the main point is just to show you that compounding gains can have a huge effect on the total account balance over time, and to not shy away from small percentage gains every month. When done consistently, you can amass great wealth.